Hi, everyone. Okay, so again, just for the record, it's Saturday, November the 18th, 2023. So welcome, guys. This is part two of sort of a couple of videos just on a potential sort of steepener trade on the US yield curve. I just did the first part, which is more about the mechanics of getting the hedging ratios right between, as an example, the 2s and the 30s. But let's actually look now at some of the fundamentals and some of the issues surrounding this potential trade. Okay, so let's just first of all, let's have a look at a couple of things here. And I mean, let's just see what's the big picture. So the big picture is that is the Fed on hold and will the Fed cut? Okay, so let's first of all look at what's priced in by the market. So if we just look at the Fed funds futures here, we can see that indeed implied rate of change for the Fed at the December meeting is absolutely zero. And then what's priced in for the end of January is absolutely zero. And thereafter, we start to see some negative signs, some minus signs coming in. And we see that, the market is essentially pricing in minus 20 basis points by the beginning of May. And then by the middle of June, minus 33 basis points. So depending on a little bit of data here and there, we have this idea that the Fed will basically hold for essentially, let's say 5 to 6 months from now. And then we'll start a cutting cycle. And basically by, let's say like 12 months from now, the end of 2024, beginning of 2025, the Fed will have cut 4 times. So essentially from this sort of terminal rate of about 5.33, we're going to get down to about 4.33 or something like that. About 100 basis points is priced in. Why would the Fed be doing this? Because the narrative runs that there's going to be the lags of the tightening sort of monetary policy will sort of cut in. We're going to have a sort of a refinancing cliff for especially high debt, highly indebted companies. Junk yields are going to go up. The spreads are going to blow out. The unemployment rate will go up, and basically we will have either sort of a mild recession or a soft landing. But at a certain point, the Fed will need to cut just to kind of stimulate the economy. And also the narrative is that inflation is on the way down. So we have inflation going down. The economy is not going to collapse, but with inflation going down and the economy softening a little bit, weakening a little bit, or maybe, a medium level of inflation, the Fed will pause for a few months and then will start to cut. Okay, now why do we care? And therefore the logic goes, and this is where we can start looking at a few different sort of charts in here. The logic goes, whenever the Fed starts a cutting cycle, the yield curve steepens, and therefore there's a trade to be done. So let's, before we look at some stuff, let's just look at, I know a lot of you guys, know what I'm about to say here, but let's just have a quick look. And again, as I just showed in the first video, but we'll just quickly refresh our memory. We'll look at, let's say, the 2s to the 30s. And again, the similar logic is going to be on the 5s, 30s, or the 2s, 10s, whatever. But the basic logic goes that, at this point, we're about minus 30 basis points. If you look at the differential between the 30-year yield and the 2-year yield, and if we actually zoom out here and we go out to this on the daily, and we go all the way back to, hypothetically, what was the high here? About, let's say, the May 2021, we go, that's plus 2.4%. So we've got about, let's call it about 250 basis points to go. And if we even go back even further, let's say something like on a weekly chart, we can see that this number, suddenly goes out to about 4%. And so the logic goes, well, we have about maybe 430 basis points or 350 basis points of steepening. So it basically means we're at the lows, well, close to the lows. We've had a double bottom retest, and the next way up is up to, let's say, 2%, and then maybe 3%, and then 3.5%, maybe even 4%. So all we need to do is just to put on the steepener trade, which essentially means, in some shape or form, buying the front end, selling a longer duration, so the 10 or the 30 against, for example, like the 2 or the 5, getting the hedge ratios correct, which we discussed in the previous video, and just sort of letting it run for 6 or 12 months, and we will make a lot of money. Now, is that valid? Let's have a look. Let's just look at some of the issues around that. So the first thing I just want to see is to say, well, okay, let's check out if this actually has been true. So what I've got here, guys, is a chart of this is the effective Fed funds rate. So let's say the Fed funds rate. Now that's the one in white. Okay, so you see here the Fed. This is in the white, and this is going back quite a long time. So this is going back to 1999. When Prince sung his song. Anyway, going back to 1999. And what we can see here is that if we just look at the white one, which is the effective Fed funds rate, which is, here on the white here, we can see that indeed the Fed, the hike and then they sort of, and then they, oh no, do I have the tracker on here? Yeah. So the Fed hikes, they hold normally for, a period of time. In this case, it was from, let's say, the beginning of July until, let's say, about the beginning of December. So that's about, what, 4 or 5 months. And then, boom, they go down, and then they do a hiking cycle. And let's say we go, to this point, we go to 2007. Then they hold from, looks like about beginning of August until that was almost a year. So that was a whole year. Then they cut. Then we had this little mini one. They hold again. And now that's where we're at. So at this point, the idea is to say, well, okay, in the last 20 years, we've had essentially 4 hiking cycles. This one here in 2017-18 was not as aggressive. But this recent one, which we may be at the end of, and probably are very, very close to being at the end of, has been a pretty aggressive one, as you guys will see. So the first question is to say, okay, great. What happens? So the Fed hikes, they generally seem to hold for, 6 to 12 months, sometimes more, sometimes less. And then generally they start to cut. Okay, now let's just have a look here. Let's compare here. The blue line now is just the 2-year yield. So not the yield curve, just the 2-year yield. Does it follow the general path of the Fed funds? And again, we know that's the most policy sensitive, so it's no surprise at all to see that, yes, indeed, when the Fed starts, the yield on the 2-year goes up along with the Fed funds rate, the effective Fed funds rate. And then basically, as the Fed starts to cut, indeed, we see the blue line, which is the 2-year yield, goes down. Same thing here. Then it comes down, exactly. So there's no problem there. So really, the next thing we're trying to say was, well, okay, is there a delay or anticipation? My point is that do traders look and go, the Fed's about to sort of end their cutting cycle. We don't exactly know, sorry, their hiking cycle. We don't know when they're going to begin, how long they're going to hold, just keep it on hold. And we don't know exactly when they're going to cut. So does the first question we need to, there's several questions. Is the Fed finished their hiking cycle? Most probably we're very close to that. How long will they hold at that elevated level, and how much will they cut? So these are the 3 basic questions we always have to be keeping in mind. But my first thing to notice here is that what we see is that, okay, so when does the, I wonder if I can just zoom this in a bit. My first question is to say, well, okay, when is there a point that the 2-year yield starts to anticipate the cuts? And what we can see here, going back, I mean, I know it's going back a long time here, 2000, we see that indeed the 2-year yield actually started to fall a few months before the Fed started to actually cut. So there was an anticipation by the market front running the Fed's cuts. Okay, let's look at this cycle in the great financial crisis. We see that the peak of the 2-year was on, let's call it the beginning of July, and the Fed funds rate didn't really start falling, wasn't really cut until, essentially 1 year later. That's quite interesting. So it kind of plateaued, and then it went down. So you could say there was a small anticipation there. Again, if we look at this cycle, which Powell was involved in 2018-19, we see that the peak of the 2-year yield indeed did, was, let's say here, that's so that's beginning of November, and we can see that the Fed funds rate really only started to fall off a cliff about 6 months later. So this was about 5 or 6 months before. So now, of course, we get to where we are now. So my first conclusion would be to say that in general, it does seem as though the market, hold on, I'm just trying to get rid of this thing. It does seem that in general, the market does seem to anticipate by several months that the 2-year yield comes down before the Fed actually starts cutting, in the sense that the effective Fed funds rate starts to fall. Okay, so what we can see now is that we've got the 2-year. I mean, maybe that's the peak. Maybe we actually saw the peak at the beginning of November, so 18 days ago or so, but we still see that the Fed funds rate is up here. So who knows, maybe that actually was the peak. So the real question here is, how long will the Fed keep it on hold? And again, we don't really know. That's going to depend on a lot of factors. It's going to depend on data from the real economy. It's going to depend on forward guidance from the FOMC. It's going to depend on sort of committee members from the Fed. It's going to depend on probably election politics and White House politics and probably inflation. So there's a lot of moving parts here, and obviously the market's going to think about those. But the basic point here is that, yes, the 2-year yield does seem to anticipate by anything from 3, 6 to 12 months the cutting cycle. Okay, so far so good. Okay, so what about the yield curve? So let's look at the 2s to the 30s. So we're going to a different chart here, and again, similar kind of thing here. Again, what we have here in the blue is what we just saw, which is the effective Fed funds rate, which, as we see, actually, I'll put this back a bit. We'll take that back to the similar time frame, so 1999. I don't think this one's normalized, so it's a bit weird here, but let's see if I just need to move this out, guys. I might just move this a little bit there. That's okay. You get the point. So what we're trying to say here, this is now is the 2s to the 30s. So the white line here is the, actually, I'm going to get rid of this. It's a bit distracting. The white line here is the 2s 30s yield curve. Now we actually, as we see now, we're at about, it's negative. Negative 30 basis points you see over here. Okay, so this is the value here of the yield curve. And we know that that's negative about 30 basis points. And our theory is that that's going to steepen, or that's many people's theory. I don't know if it's my theory, but it's going to steepen is the idea. So what we're trying to anticipate, we saw that the 2-year yield often front runs, so to speak, when the effective Fed funds rate actually falls. So is that the case? Now, what we saw in 2022 is that this is, what I'm trying to do here, guys, I just wonder if I can make this, just give me a second here. I'm going to try and see if I can just make this a little more friendly. Oh, no, it's okay. All right. So what we can see here is that this is the peak of the flattening, which was on the 30th of April 2000. But as you can see, the Fed didn't start cutting until about the 28th of the 2nd, 2001. So that's about, what's that, 10 or 11 months after. So what's interesting is that by the time the effective Fed funds rate actually came down, the curve had started to steepen. And of course, as the Fed funds rate came down, the curve steepened a lot more. Okay, let's look at the great financial crisis. And again, we can see that the trough or the low point of the 2s 30s curve, I mean, it depends which way you sort of cut the cake here, but we can say that it was at, let's say spring, so March of 2006, let's say in 2006. But what's interesting is that that was the bottom and it started to steepen. And we see that the effective Fed funds rate didn't really come down to the middle of 2007. So again, I think it's reasonable supposition to say that yes, not only do the 2-year yields sort of front run the effective Fed funds rate coming down, but also the yield curve did start to steepen. Okay, so let's now go back to this period in 2018, 2019. Is that the case? And we can see that again, the curve was at its flattest or most inverted, looks like basically beginning of October 2018 October. And again, we see that the curve, I mean, it's a bit wonky, this one, but we see that again, it did seem to predate the effective Fed funds rate coming down by, again, quite a few months, like 6 months or so. So I think at this point, it's a reasonable supposition to say that, at least if we look at, the 3 or 4 hiking cycles and subsequent cutting cycles of the 21st century, we can say that in general, both the 2-year yield sort of front runs the effective Fed funds rate coming down, but also the curve reaches its nadir, its trough, and then starts to sort of steepen 3-6 months before the Fed starts cutting. And I was reading some research the other day, and I think the number which they came up with is about, in general, it's between 3 and 6 months before the Fed actually announces the first cut, before the Fed actually cuts, that the yield curve does start to steepen. So the thing is that based on all of that, I mean, I suppose what we can, what we can say, we'll just go back. I just want to put this back on, let's say, for example, the daily. Let me just put this on the daily chart, maybe going back 5 years or so. It does seem to be a reasonable supposition to say that, yes, once the Fed is perceived to be sort of cutting, then the curve should start to steepen. Okay, so therefore the question is, well, why don't we just, if we assume that the Fed's going to start cutting, well, the market's saying the Fed's going to start cutting in May, June, July, therefore we just put on the steepener and hold it and everything will be good. Now, I think if you're an institution, you don't really worry about the cost of carry. And let's just think about the cost of carry, guys. Keep in mind that if you're buying a cash bond and you're spending $1 million, you'll receive some interest. Okay, but you have to outlay, let's say, $1 million, and you'll get your, 5 point whatever % interest on let's say, a 2-year bond. If I'm buying ZT or TU futures, so 2-year futures, as we discussed in the first video, I'm only, putting a fraction of that as margin, maybe $1,000 to control 100,000. So I have sort of a leverage of about 100 to 1. But the point is, the market says, well, okay, if you're going to use all this leverage, the cost of that interest is included in the futures cost. It's discounted, because otherwise no one would ever buy cash bonds and say, well, hey, why am I going to use $1 million or $100,000 of capital to buy a bond, and I can control $100,000 of notional with just 1,000. So that's discounted. So the point is that there is a cost of carry. The more inverted the curve, the more onerous, or the heavier is the cost of carry. There's no free lunch. So you have to understand that if you're holding this trade, you are literally, the cost of carry is the fact that to borrow that margin, you're actually paying more overnight, if you look at the repo rates to your broker, than you're actually earning on the interest payment. There's a difference there. There's a cost of carry. You're actually losing money to hold the trade. Now, when I say losing money, obviously, if the curve is steepening every day, you're making more on the curve steepening than you're losing money. But if nothing happens, then technically you're losing every day. It's almost like, think about it for those of you who trade options, like a theta burn kind of situation. You need the curve to steepen. It's not negligible, because as we discussed in the first video, you have to understand that if you, let's say the minimum size of, let's say, short 130-year futures versus 4 long ZTs, the ZTs are $200,000 notional. So that's 4 times 200,000, which is 800,000. Plus, of course, you've got your ZB, which is another 100,000. So that's $900,000 notional. If you're putting on a 4 or 5 kind of lot combination, you might be controlling $5 or $10 million worth of notional, and you'll be paying interest on that. Just saying, there's no free lunch. Okay, so do we assume? So therefore, the next question to say was, okay, is this a good moment to be putting on the steepener? And again, I would say that if you have plenty of capital and you can take potential pain, absolutely. But let's look at the factors involved. So the factors involved is that, what's the curve been doing? And we can see if we just go to a chart. So let's just go back to a basic trading view chart of the 2s, 30s. Let's have a look. So the curve started to steepen, from the middle of March. Okay, and what was this? This was probably a bull steepener. This was the banking crisis. So let's just quickly review very quickly. We're saying, well, okay, the curve should steepen. And we've seen that historically, it's absolutely 100% true that once the market thinks the Fed has stopped hiking and thinks the Fed is about to embark on a cutting cycle, that the curve normally from a deeply inverted position from where we are today should and probably will steepen. The question is timing. Okay, currently the market is saying that the Fed is going to start cutting in about 6 months. And we just saw that normally the curve starts steepening, 3, 4, 5 months before. So one could argue that this is not a bad time to put that trade on, or to at least start building a position. But let's just review a few things. Why on earth would the curve flatten? That's the thing we have to say. We say, well, okay, is there anything, a counter argument? And we go, I mean, is it possible that it sort of flattens down here before it starts steeping? Is that possible? I don't know. What could possibly cause the curve to flatten? Now, and indeed, what we have to see is that the curve started steepening in March, but then it kind of flattened a bit, then steepened, then it flattened, then it steepened and steepened pretty aggressively, and is now technically we're in a flattening stage. So what's going on? Now remember that in order to flatten, there are 2 ways that the curve can flatten. Okay, so it can bear flatten, which basically means led by the front end. The front end yields are going, or the prices are coming down, and the yields are going up very aggressively. So what would cause a front end led bear flattener would be obviously if the market perceives that the Fed is going to be hiking more. Now, is the Fed going to be hiking more? The market, we just saw, is basically saying no, but it's not yet maybe 100% convinced. And I would say that as recently as, last 2 or 3 days, we've had, FOMC members fighting back and saying, well, we may be hiking one more time. Now, do I believe it? Not necessarily. Do you believe it? Not necessarily. Does the market believe it? Not necessarily. But we don't actually have the final green light until we get the true pivot, the true sort of, active green light. There's always a small danger, a very, very small danger that the Fed will hike again. Do I think they're going to hike again? Probably not. Or at least one way of saying that is that the bar for the Fed to hike again is very minimal. So can we say that, this kind of flattening here and this flattening here is a bear flattening? A little bit, and because the point is that we're still getting data which is flip-flopping a little bit. But the other issue is to say, well, okay, is there another way for the curve to flatten? Can a bull flatten? And what does that mean? That means that the long-term yields this time are coming down more aggressively than the front-term yields. And why would that be? That could be on geopolitics, could be like geopolitical risk. And unfortunately, we've had these horrible events in Israel and then the subsequent, events in Gaza and Ukraine. So there has been a little bit of a bid for the bonds. It also could be a lower than expected growth. The idea that the future path of economic growth is slowing down a little bit. It could be that inflation expectations are coming down and inflation is coming down, which is going to be positive for the long-term yields to come down a little bit. And again, guys, we saw that on Thursday, we saw on, this is on the weekly chart here. Let's just go back to the daily chart. We saw that, indeed, we did have the CPI reading, which was pretty low. We had a very sort of soft CPI reading. Okay, so that's that. And the other possibility is the question of supply. If the market believes that there is less supply coming into the market, that is going to be positive for long-term bonds, which will bring down their yields, which will cause a long end led bull flattener. And I just want to have a look at a few things here, guys, and let's think about the supply issue. When we had the QRA, the quarterly refunding announcement, which is the amount of bonds which the Treasury believes they need to sell to cover the US spending, the deficit essentially. If we go back to the first one, which was all the way back at the beginning of August here, we saw that caused a big steepener. Okay, that was a bear steepener because there were a lot more bonds issued and coupons issued than short-term bills, and the market freaked out a little bit. But what we've subsequently had is, the most recent quarterly refunding announcement, which was on Monday and then the Wednesday for the details. That was less than expected. Okay, so first of all, there's a technical barrier here. Up here, but really the issue is that quarterly refunding announcement surprised the market in a positive way, that there was a less than expected issuance, and that secondly, the proportion of bills was much higher than expected, the proportion of bills to bonds and coupons. So basically less issuance on the long end, which the market took as a wonderful thing, beautiful opportunity to flatten, a bull flattening, which as we all know also caused a huge asset rally in assets in gold and the equities, et cetera, as yields came down, just outright yields came down. So the question we have to say, guys, is that, is it possible for the curve to further flatten? Now, if the economic data continues to come in, well, let's say the economic data comes in hot, the next CPI reading comes in hot, the initial jobless claims, the labor market comes in hot, the initial jobless claims comes in lower than expected. The Fed remains hawkish, and Jerome Powell remains hawkish. Is it possible for this to bear flatten? It is absolutely possible. Is it possible to bull flatten? Yes. We just need continuation of what we've been seeing. We have Janet Yellen at the Treasury going, hey, I work for Joe Biden now. I really want to push out all of this long-term issuance. We have to do it because we have a huge deficit. But let's just deal with that maybe in 2025 or something like that, because we have an election coming up. So it is possible that even though US deficits are enormous, and at some point they will need to issue more bonds and longer-term coupons, maybe they're just going to sort of, not take the pressure off for the next 6 or 8 months. Maybe on the other hand, instead of getting hot data, which would necessitate sort of a bear flattener on the idea that the Fed will hike a bit more, maybe let's say the Fed doesn't want to hike anymore, but maybe let's say, for example, the inflation continues to come down. And let's say, for example, the economic growth and the economic data is not disastrous, but just sort of slowly deflates, a soft landing, maybe what happens is that the long-term bonds go, hey, we're okay with this. There's not too much inflation. We can just, sort of flatten a little bit, okay? And just talking about inflation, just want to look at one little thing here, guys. So let's just see what's going on with inflation expectations. So if I go back to a chart here, I think I've got the inflation. Yeah, we'll go here. So let's just have a look at this. We've got the five-year break-even inflation. So this is where the market, in medium term thinks inflation will be. And look at that, guys. Look at that. I mean, this is a daily chart, but I mean, the direction of travel is going downwards. So the market believes, this is market-based pricing. The market believes that the average inflation rate 5 years from now for the next 5 years, so kind of over the next 10 years, the medium-term inflation rate is going down. Inflation expectations, according to the market, are anchored. So is that a problem for the long-term bonds? No, that's not a problem at all. In fact, the long-term bonds are loving that. They're absolutely loving that. Okay, and that's positive. So that technically is going to be supportive for long-term bonds, which, as we know, in theory, causes a bull flattening, if anything, of the curve. Okay, just saying. Now, what about the other possibility? Well, why would the curve need to steepen a little bit more? And again, let's just go back to the chart. But we're saying, well, hold on, Angus, that's possible. That's possible. But why wouldn't it just keep on steepening? And again, it assumes that the Fed will hold rates for only a certain period of time, and then they will start cutting and cutting aggressively. But how much are they going to cut? We don't know. Because my point here, guys, is that let's look at the two scenarios for a steepener, a bull steepener. Okay, how can a bull steepen? The Fed cuts rates relatively aggressively. Now, under what conditions would they do that? They would do that if, okay, let's say that inflation came down strongly, and that is possible. We saw that we seem to be seeing that the core PCE well, let's say the headline CPI is coming down. But again, the issue, guys, is that medium-term inflation expectations are still anchored, but the reality is that core PCE and core CPI, which we saw just a few days ago, is still higher than the Fed. But let's assume that inflation comes down. And let's assume that maybe the real economy starts to weaken, like a labor market gets worse, unemployment goes up to 4.2, 4.3, 4.4%, et cetera, et cetera. Can the Fed cut? Absolutely. But my point is, guys, that's priced in. That's already priced in. You say, well, it's not a surprise to anyone. So let's see what's priced in. Okay, let's have a look and see what's priced in. So we can look, for example, and I'll just do one metric of that. Let's have a look here. What have I got? Yeah. Okay. So let's look at a short-term interest rate. So let's look at the SOFRs, which is the 3-month, the very short-term one, which tracks the Fed. If we take, for example, December 23, subtract December 24, we can see basically that actually, as we speak, 100 basis points are priced in. So what the market is saying is that 100 basis points are priced in that 12-month period. So the thing is, guys, that technically, the market understands or believes or has priced in that the Fed will cut 4 times. Okay, I think I have another one. Let's look at hold on, no, I don't have another one. Okay, let's look at a couple of other charts and just see what's sort of priced in. So again, if we look at this is the Fed funds rate now, the Fed funds rate in implied yields, we can see that the orange line is where more or less now, like from yesterday, Friday, we can see that from 1 month ago is the green line, and we can see that the market has priced in more dovishness. You see how they've brought it all down. These bars down here are telling us in basis points how much more dovish the market has been in the last month, and we can see that starting off in, let's say, 2024, end of 2024, going to 2024, the market is priced in for each month, between 10 and like 25 basis points of more cuts. So that's more dovishness priced in. Okay, if we look at the yield curve here, or actually the whole curve of the US Treasuries. So let's have a look here. We start at the 1 month going all the way up to the 30-year. And again, if we look at a couple of different dates, we can look at before the quarterly refunding announcement at the end of October. So I just chose the 27th of October. That's the orange line. And what you guys can see is that the curve has come down a lot compared in the last month. So the shape of the curve hasn't changed that much. At the front end, look at this, guys. The front end, the curve hasn't come down that much. It's all dovish. The yields have all come down all across from 1 month all the way up to 30 years. But where's the big change? You can see that the big change really starts, with the 5 years, 7s, 10s, 20s, and 30s. And you can see that the big changes are at the belly to the long end of the curve. That means that those yields are coming down more, which is flattening the curve. It's bull flattening the curve. So why would that be? Again, it comes down to this narrative that inflation expectations are contained, and maybe inflation is actually slowly coming down to where the Fed wants it. And it's also coming down to the fact that the real economy is slowing, but not so much. And I have to be very subtle in the way I express this. There's a difference between the economy collapsing and the economy slowly losing steam. If inflation is slowly coming down, if the economy is relatively robust but slowly losing steam, maybe the Fed does not have to do emergency cuts. It doesn't have to aggressively cut. It can simply hang out at the current rates for maybe 3, 6, or 9 months and can slowly let the 2-year yields and the Fed funds rate and all that kind of stuff, yeah, they might cut 25 basis points, then another 25, then another 25. Now, if that's the case, guys, we could argue that that's fully priced in and that actually it's not really a negative for the long end of the curve. And that could just be, a flattening of the curve, a bull flattening of the curve. How could we get a bull steepening of the curve, which what a lot of people are saying? We would only get an aggressive bull steepening of the curve in the short term. I'm not talking about over a 12 to 18 month time horizon. I'm saying in the short term, to get an aggressive bull steepener, we would need the economy to aggressively lose energy. Okay. Now everyone's talking about the initial jobless claims last Thursday. It's like, oh my God, the labor market. At the end of the day, guys, it's still historically very, very solid. The non-farm payrolls is pretty solid. For sure, is the labor market slowly losing steam? Yes. A retail sales may be losing steam a little bit, maybe, not much. The economy is still relatively strong, which is not to say that the economy will not weaken over the next 6 to 9 to 12 months, but maybe not enough to warrant the Fed having to start cutting earlier and more aggressively, more than is currently priced in. So what I'm trying to say is that the arguments for the aggressive bull steepener, so the 2-year yields collapse, it would require a significantly more aggressive deterioration in the real economy, in the labor market, and all kinds of stuff. And maybe even inflation would have to really start collapsing. But again, guys, just keep in mind that we had the core CPI, I think, was still at 4%. 4%, not 3, not 2.5, at 4%. Is it trending in the right direction? Absolutely, absolutely. But at this point, remember that Jerome Powell was kind of humiliated by being too late to hike interest rates back in 2021, and he waited until March 2022. He does not want to be known as the Arthur Burns. And remember, Arthur Burns was the head of the Fed back 20, 30 years, who saw inflation coming down a little bit, stopped, was dovish, and then inflation started ripping again. Jerome Powell's legacy is that he wants to not be known as Arthur Burns. He wants to be known as the guy who slayed, who killed inflation. So I personally think he'd be quite happy, unless the real economy absolutely has a disastrous sort of falling off, to say, hey, we're going to keep, interest rates at this level until he's absolutely convinced he sees many multiple readings of the CPI core and the core PCE down, to, I don't know, 2.5, 2.3, 2.2%. Because there's no upside for him really to let inflation go up, and then he'll just have a failed legacy. But of course, anything can happen. So all I'm trying to say here is that understand that the risks for further flattening exists. And again, you have to think, why would it bull flatten? Why would it bear flatten? bear flattening, I think would be a low probability. Is the Fed going to hike more? Probably not. Probably not. But the bull flattening, a soft bull flattening, or even something like this kind of situation, I think is sort of possible, maybe for quite a few months. So the question is, you've got to really think about your time frame. How are you going to execute this trade? Are you happy if it just drifts down? Maybe it's going to drift down to 70 basis points. But as we saw in the first video, if you have a little bit of size on 10, 20, 30, 40 basis points, you'll be losing quite a lot of money. On the other hand, is this a good opportunity just to scale in? Yeah, absolutely. It's a great opportunity. You can scale in here. If it keeps on going down, maybe every 5 or 10 basis points you add a little bit of extra size. And just one thing I kind of want to finish off here, guys, is when I'm saying things are priced in, I just showed you the SOFA's curve, and the SOFA's curve is fully pricing in about 100 basis points of cuts sometime in 2024. It's no surprise. So let's just look at a couple of charts here. This is just interesting. Remember as well, if you're doing a futures trade, that you need to roll over every 3 months. Okay, so let's look at something like the ZT. Now, this is the ZT. I'm going to put this on the current contract, which is, of course, ZT December 2023. So we'll just put it there. Okay, and what do we see? We see the price at the moment is about 101.15.7. Great. Okay. Now, our basic thesis, or a thesis, could be that, and by the way, I kind of agree with this. Like, don't get me wrong. We all know that the curve will steepen probably over the next 6, 12, 18 months very aggressively. But I'm simply saying, let's just understand the mechanics of this as well. This is the current 2-year note at 101.15.7. And we're basically saying that, hey, yeah, over the next month or two, it could fiddle around, could go down a little bit more, but surely we're kind of more or less, basing formation, and it's going to go up probably. Quite probably that is going to be the situation. Could it retest lows? Yeah. But the point is, guys, let's say you're holding this trade and you're holding, and it's like, oh, the December contract we need to roll over. You say, no problem. I'm just going to roll over. I'll sell that. I'll exit this one, roll it over, sell out of this position, and just roll it over and buy the next one. Now remember, 101.15.7. But let's look at how much the ZT for March is currently trading at. Okay, so now we roll it over. Next 3 months, we now have March 2024. Okay. Now you'll notice, guys, what's the new price? 101.29.3. It's currently trading. You can trade it now. It's trading at 101.29.3, the March contract, which is, guys, 110 ticks higher today than the current December contract. So that means when you roll it over, you have to rebuy your positions 110 ticks more expensively. You just don't slip into one from the other. You will be losing 110 ticks on every single contract. What's that? $7.81 a tick. What's that? About $800 per ZT contract, for example. Okay, the ZB is more stable. But my point is that this differential of 110 ticks, as we speak today, is exactly the market pricing in. It's discounting the future change in interest rates and yields. The market's not stupid. The market doesn't wait and go, oh, well, when we say priced in, we mean priced in. So another possibility to think about is maybe say, I mean, again, it's not perfect and it's a bit complicated from a mathematical point of view, but another possibility is to say that if you did want to enter this trade, which by the way, I think is absolutely legitimate, is to be prepared that it could flatten a little bit, be prepared for a bumpy ride, maybe over the next month or 2 or 3, and for the aggressive bull steepening may not happen for many, many months. But for sure, you could maybe start to build a position. And keep in mind that if you want to do that, maybe, who knows, maybe it makes sense potentially, rather than entering on the current December 2023 contracts, maybe you could enter, let's say you could go long the ZT for at least, let's say maybe the March 2024 contract. There's enough liquidity to slowly build a position. And conversely, you could be selling the March 24 ZB contract, or maybe the ZN, if you want to do the 2s, 10s. But just keep in mind that all of those, at this point, 100 basis points is technically already baked into the cake. So to really make a lot of money, if you're going to hold this more than anything short term, you have to assume that the Fed will cut more aggressively than is currently priced in we enter the trade. 100 basis points of cuts between now and December 24 is priced in. And if you hold this trade, you're going to be bled out just from the carry costs. So I would say, if you believe the Fed is going to is going to cut more quickly than the market is currently pricing in, or more aggressively, absolutely this trade will make money. I think a good way to do that would be, as I said, at least to maybe get in on the March contracts rather than the December contracts. And secondly, I would say also it's a possibility to trade it more tactically. If you see a pullback of 10 or 15 basis points in the spread, let's say the 30s to the 2s, which we'll go back to here, you say, okay, this is an attractive entry level, and maybe you take a bit of profit here. Like, the point is, you can scale in, you can scale out. You don't just have to sit on your hands. I mean, the idea is here that you could, if it reaches a profit target, let's say, for example, you get in here and it reaches up there, you could assume that maybe it's going to pull back a little bit. Maybe you take a little bit of profit. It pulls back to a fib level, then you can maybe re-enter a little bit there. I'm not sure this thing is just going to keep on ripping, especially over the next 2 or 3 months, okay? The real money, and again, guys, let's just put this back on the weekly trade. I also don't think there's, one can be kind of patient here, and just keep in mind, this is a weekly chart. We're still relatively early. The big money is still to be made is the aggressive bull steepening. The moment where it is absolutely, we're given the green light by the Fed that they are done, and that there's going to be a second green light where they sort of indicate that they're ready at some point. They'll give the market 2 or 3 months notice that they're ready to start cutting. Okay, unless we get some crazy situation like COVID where you have to cut on a Sunday night. But so what I'm trying to say is there are kind of 2 parts to this. Number one is the signal from the Fed that they are finished hiking, and we could get that very soon. We could get that signal, leading up to the December interest rate decision, or maybe the January Fed decision. They might sort of go, Powell might do one of these little comments and go, oh, we're kind of okay for the moment. That obviously is going to be very dovish, and that, yes, would cause a bull steepener, pretty aggressive. And then maybe that's the moment to trigger the big size. At the moment, you can trade it tactically. But the second one, because what I'm trying to say is that you get a little move here, but the big move, the generational wealth move, like of 200, 300, 400 basis points, that's probably going to come, not for another few months. So the real issue here is, are you okay just to deal with the short-term volatility? And a little bit of the cost of carry. And remember that as the yield curve slowly disinverts, the cost of carry becomes less onerous. And so that whole issue about, what you're paying to be in the trade is less of an issue. Okay, guys, so I hope that was sort of useful. But again, I just want to sort of summarize by saying, yes, absolutely, going back to the beginning of the video, when the market perceives that the Fed is stopped hiking, and more to the point, 3 or 4 months before the market, 3 or 4 months before the Fed starts to cut, or when the market perceives it's about to cut, that's when the very, very, very aggressive 200, 300, 400 basis points of bull steepening occurs. And don't worry, there'll be plenty of money to be made in that trade. But anyway, let's keep on talking about it. It's an interesting one. And what I would say, guys, don't assume as well, don't be buying the TLT, because on a comparative basis, the front end yields will move a lot more down than the long-term yields. Long-term yields, like historically, I've read a lot of stuff, done some research. The long-term yields, the 30-year yields might move down, 100 basis points or so, or the 10-year. The front end's going to go down 200, 300, 400. So, at some point, even if you don't want to do the steepener trade, I do believe that, like, maybe even just buying outright ZT, or maybe the ETF TUA, which is a leverage 2-year one, TUA, the ticker on the ETF, is a nice way of playing that as well. Okay, guys, probably rambled on for far too long. I'll leave it there. Hopefully that was interesting and informative. Thank you. Have a great rest of the weekend. Ciao.